Hi, Shae Russell here, and sitting next to me is Egon von Greyerz from Matterhorn Asset Management. Egon, thank you for joining me on the couch today.
Great to be here.
Now, we're both here in Sydney for the Gold and Alternative Investments Conference. It's still a bit of a mouthful for me to say each time. And I was quite taken with your presentation yesterday.
Right.
For starters, it was energetic. Often when you come to these things, they can be a little bit dry, but you made yours fun. And you started really strong by coming up and saying, I'm clearly on another planet.
Yeah.
Yeah. So let's explain to the audience why you said, I'm clearly on another planet.
Well, it was very simple. It was this CEO of Perth Mint, Richard, who said that anyone who holds more than 5 to 10% in gold comes from a different planet. So obviously, the first thing I had to say then, because I was speaking right after him, I'm from a different planet. Because when we started with gold already in 2002, I told people that I think you can hold up to 50% in physical gold.
That's quite a bullish.
Well, it is, but because in my whole life I've tried to understand risk and had to understand the downside. The upside always takes care of itself, but the downside is what kills you. And I saw that all these problems of debt building up and derivatives building up, and you never know when it will happen. The only thing you know is that you have to have your fire insurance before the fire starts. So that's why we started. And of course, the time you buy an asset is when it's unloved and undervalued. So when we went in was in 2002 when gold was $300. Can't remember what it in US dollars. I can't remember what it was in Australian dollars, but it was pretty low. I would guess it might have been the same or so.
Look, it was about $450 back then.
Was
so
it that
yeah.
High? Was it that high? Yeah.
Just after the market crash, the 2001 .com bubble, the Aussie dollar sank 250 cents of the US dollar. Okay, so it tanked.
So anyway, that's most people buy when it's on the front pages or on television, whatever. Sadly, and especially amateurs, they buy high and sell low. But here, when you buy something that it has real value, which I consider gold had, is undervalued, but primarily is the best insurance you can have against the risks I saw in the financial system. So that was the reason, very simple.
Do you know, it's actually great that you said, it's about the downside that matters. When you just threw out that line, the upside takes care of itself, that's a very good point, but it's the downside that matters. So how did you formulate a 50% weighting to gold in 2002? Because that was not a common strategy back then. Well,
I've never been a believer in conventional wisdom because, conventional wisdom, all it is conventional. There's no wisdom. Therefore, most people just believe that, they do what the masses do, and I always try to think differently. My wife doesn't always like that, but of course I don't always agree with everybody. But nevertheless, so to me it was obvious. The question isn't really why did I put 50% only in gold? Why not more? Because my question is, if I see the risk as major as I see them in the world, and of course since then risk has gone up exponentially, debt has gone up exponentially. Now we're still talking about 17 years ago. It's a long time. I'm glad I'm still alive, by the way. It's a long time to wait. But nevertheless, so now the risk is much, much higher, and at that time I saw that the risk were coming, and of course it did happen in 2007, 8, 9. So the judgment was right. It doesn't happen the day after you do it, but of course gold was then going up from $300, and then in the US it went to 1900, 1920 in 2011, and then we've seen now this 6-7 year correction. But so now I would say the risk I see now, I would say 50% is low. So I'm on yet another planet higher up now.
I love it. You've got to back your view. I think that's fantastic. So how did your clients receive that very unconventional wisdom that you were saying, let's put 50% in gold?
Well, let's say that first, the first investors. So we were some business friends of mine. We had invested together. and I had investment in a couple of companies, and we actually sold. I recommended that we sell a company just at the end of or beginning of 2000 at a e-commerce.com type company, because I saw the risk coming then. I said we got to get out, and we did, and the market crashed by 80%, and most of these businesses went bust. So these people then, and a few other my friends, they invested a major part of the proceeds in gold, and then because they trusted me because I made the right decisions for them, and then later on, you can't, if you tell anybody you should have X% in gold. Remember that only less than 0.5% of financial assets are in gold in the world, of global financial assets. And that means that the 99.5 or more don't hold gold, don't understand gold, are not interested to listen to the story, especially back then when there was even less risk that you could see, at least. I thought the risk was there anyway. So therefore, what we've done throughout the whole of this period, when this is for me a hobby, it's not a job. I should be retired, but this is too much fun to just stop doing it. So I hope I'll die on the job.
Oh, that's a great attitude to have. Actually, I like that.
Sure, I never intend to retire. So.
Oh, I have to have the same strategy, believe it or not. All right, so let's talk debt. You put some pretty phenomenal debt predictions out in your presentation yesterday. So you explained how the debt is accumulating and increasing. How did you formulate that? How did you come to that perspective?
Well, it's a fact, of course, that debt was about 80 trillion in 99, global debt, and it was 125 trillion at the beginning of the great financial crisis in 2006. And then now it's gone from 125 to at least 260 trillion, so it's doubled again since 2006. But when debt doubles, risk goes up exponentially. So now we are at a maximum risk. And then, so what I did, to that in the presentation, I then added the other risks and liabilities, which first of all is derivatives. Mm-hmm. And that is, just a massive risk there's no protection there. It's just speculative paper speculation that, they hold zero reserves for that, basically. And that's the gross figure of that, the BIS, the Bank of International Settlement. There was already 7-8 years ago, there was a figure of over 1.5 trillion. And then from one day to the next, they actually changed that and just reduced it to half, basically. So it's 600 trillion now, only. But in my view, the gross figure is still there, so they've just cheated and netted it off. So we are at least, and it's growing, so we're at least a 1.5 quadrillion in my view. And of course, that's just a figure that, no one can fathom what it means, actually, 1.5 quadrillion. But, so you take world GDP is 80 trillion, and then you can see what, that's 15 times or whatever, a bit more. So that is a figure that, in my view, is at risk when something happens in the system, because derivatives function when you buy them and markets go up. But this has never been tested in a real bear market. And there would be no liquidity whatsoever. And then at that point, of course, banks net them off to a very small amount, and they have minimal reserves against them. But if actually this risk manifests itself, that 1.5 quadrillion or more will remain gross risk, because when counterparty fails, there's no one there to pay, then you have the gross risk. So that's so add that to the debt of 250 plus trillion, and then you have at least unfunded liabilities in the world of Medicare, pensions, etc., of a few hundred trillion. So you get to over 2 quadrillion debt. And that, you say, well, that will never happen. Well, that's the thing is when you have problems and nobody pays, that could become a real debt. And that could become money printed by central banks. Of course, at that point, we're into hyperinflation.
Yes.
And of course, as we all know, you can't solve a debt problem by the same means that created it in the first place. I.e., you can't solve, a debt problem by printing more money. So that won't help. And, any money printed, even today, any money that's printed by central banks, any money that's borrowed by governments, any money that commercial banks are lending out by, they get $100 deposit and they lend out $900. All of that money is fake money. Doesn't exist. And therefore, basically, they're printing fake money that will never be repaid because debt is just going up and up. Nobody can afford to repay it. And no individual can, no government can, because, you look at the U.S. debt, which is it's gone up. It was 1980, U.S. debt was almost 1 trillion, and today U.S. debt is 23 trillion. 1980 U.S. tax revenue was just under $1 trillion, and today it's 3 trillion. So debt has gone up over 30 times, and tax revenue has gone up 6 times.
They don't add up, do they?
They don't add up, so it means that the tax revenue, that nobody will ever repay the debt. So you're issuing false money, and with that, the way I define this in very simple terms, that if you use fake money and you create fake assets, whether that's stock or fake values, let's say, not fake assets,
value,
because you do the assets, actually the building's there. I think but I see outside here.
It's just not worth as much as we think it is.
So you create assets that are massively overvalued, and at some point in the next few years, so I see then a failure, because in the debt system has to fail, and it will just crash by its own weight at some point. And of course, if debt implodes, before that you'll have massive money printing. So instead of having now, as I said, debts of 250 trillion, you will print money for the derivatives and for the other liabilities. So you might have printed a few quadrillion at that time. So you will have then also high inflation for a while, and maybe even hyperinflation. But then the assets that this fake money has financed, they're also massively overvalued. So at some point this debt will implode. Has to. That's the only way to get rid of it.
Yep.
It will implode because no one's ever going to repay it. So it's like having a forest fire. And when that implodes, so will also the values of all the assets that it financed, because if the debt is worthless, so are the assets. Sure, this building will have, that we see opposite here, an office building, I guess, it will have a value, but bricks and mortar is not worth much if it hasn't got a yield.
Yes.
So therefore, bricks and mortar in themselves has a very, very low value. So I measure everything in real terms, and real terms is gold, because gold is the only money that has maintained its value and survived throughout history. And all gold doesn't go up. We measure gold going up only because all the currencies are going down. Of course. So, but in real terms, gold is just stable purchasing power. So I measure it against gold. So all of these assets, like I said in my speech yesterday, nobody liked it, of course, because you like to see your property values go up all the time, and you think you're becoming so rich.
It's an obscene obsession, isn't it?
Yeah, and it's not real, I'm telling you, it's not real. It's not a real value, don't believe.
Well, that's a perfect lead into what was my next question, and it was, what did you say about gold that the Aussie audience didn't like?
No, so let me just say,
property. What did you say about property that the Aussie audience
in real
didn't
terms,
like?
i.e. against gold, I think it'll go down 95%.
In relation to gold?
In relation to gold, and gold is real money, stable purchasing power. I think there's a risk of that, because it'll go, of course, from being overvalued to undervalued. That always happens. So, and that can happen, and the same with the stock market, also go down to the same extent against gold. So that's a risk that we can see in the next 5 years or so. Of course, I hope it won't happen, but I don't see a solution to the problem.
Do you know, and you actually made a very compelling reasons for why individuals should hold gold yesterday on stage. And I'm paraphrasing a bit here because I didn't write the exact quote down, but it was, if you're standing next to the printing press, you're going to benefit from quantitative easing. But if you're not next to it, then you don't. And just that statement alone really sums up why individuals should be looking at owning physical bullion.
Yes. No, absolutely. No, you know, so you take a hyperinflationary economy like Zimbabwe, you know, a few years ago when they were printing unlimited money. You know, the one who benefited from it was Mugabe and his friends, because they got the money first.
Yes.
And so they could spend it quickly or you know, or change it to some other currency, whatever. When the people got it, it was worth nothing, because it started to circulate them, and the velocity meant that it went down to nothing. So that is, you know, that's gold is real money, has been real money for 5,000 years. I'm not a gold bug, and there are times when the economy is properly managed, which it hasn't been for a long, long time, not in the last 100 years, not since the Fed was created, and so in those times, gold is, you don't need to hold 50% or more gold, as I'm saying you should have today, of your financial assets. But you know, when there is sound money, you don't have to have that much gold. You might then have, and I come down to this planet, you might have then 5 or 10% in gold.
Yes.
You know, wealthy families in Europe, for example, have always had 5 or 10%, regardless of the circumstances. The old families, but then if they, you know, if they don't print money, if they don't run deficits, etc., yeah, you don't need the insurance then to the same extent. Today you need it. You know, that is life insurance in my view, and if you don't have that, you will suffer in the next few years. And just, you see, you take just in this century, most currencies in real terms are down at least 80%, and real terms again is against gold. So therefore, you know, you've already seen a massive decline in your purchasing power, and nobody's aware of it because governments never tell you. They never tell you the truth because that would just show how they mismanage the economy. So all currencies in the world are down 80, some a little bit less like the Swiss francs, but across the board 80. And since 71, when Nixon let go of the gold backing of the dollar, they're all down 97 to 99%. So we in the gold community know this. The people around the world, nobody knows it. And of course, if something has gone down, even a child can tell you, if something has gone down 97 to 99% on a chart that way, then the remaining 2-3% will obviously happen. But we have to remember that remaining 2-3% means 100% from now. So that means that, you know, most currencies then will decline another 100% from now. And that's when we have a collapse of the system, which I think is a high risk of.
Now, we've almost run out of time today, so I've got one more question for you. And my mission is to change the conversation about gold in Australia and encourage more bullion, more people to buy bullion. As an international, you know, you're from Switzerland, you've got your international eye, you see market, you see economies all around the world. What's the one thing you can say to Australians to encourage people into buying bullion?
Yes, well, first of all, we have clients in 60 countries. Not many in Australia. I've never seen the Australians as being, you know, real gold buyers. I'm talking about physical gold now.
We're too busy throwing money into houses. Sorry.
Yes, and also, you know, everybody maybe has a little bit in the mining industry, but that's for them is not really buying gold. It's stock market speculation rather than, you know. I have one advice to Australians: study history. Whatever you do, study history. No paper money has ever survived, and we are at the end of a massive era of debt, which is probably the greatest era of speculation ever in the world because it's global. It's never happened before. So therefore, study history, and you will see that this has happened time and time again. We're very near that point now. It is not different now, whatever you believe, because that's always people think it's different today. We've got computers, we've got cryptocurrencies. It's nonsense. It's worse than ever now. Risk is higher than ever. Therefore, study history, and you will find that if you don't understand the role of gold, you will, and therefore that you should have some physical, physical gold in your own possession or in a safe vault outside the banking system. If you don't understand that, you are going to suffer greatly in the next few years. So please, please do it before it's too late.
Egon, thank you. That's a great way to end. I couldn't have put it better myself.
Okay.
So thank you very much for your time. You're very busy here down in Sydney, and I'm grateful for our chat.
All right, very good. Enjoyed it very much. Speak to you.
Thanks, Egon.
Thank you.